Vedant, we can start.
Yes. Okay. Good evening, everyone. I would like to invite our team to play the ICI motto song for setting the perfect tone for today's session.
य एष सुप्तेषु जाग्रति य एष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रदब्रह्मा तदब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चनान्यपि कश्चन एतद्वैता 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 एतद्वैता.
For the ICI motto song. Good evening to one and all. Respected Vikasa Chairman CA Jitendra Sanglani, Chairman WIRC CA Ketan Sayya sir, volunteers and all the enthusiastic attendees of this session. Wholeheartedly welcome you all in this amazing session in our ongoing Gyan Yagna series, which is deepening our understanding and strengthening our professional foundations. So topic for today is valuation of debts. But debt also has a profound value in valuation of company. This isn't just about the face amount. It's also about the true economic worth influenced by interest rate, risk, and time. Understanding debt's true value is critical. For companies, it is vital for managing its capital cost and making smart financial decisions. And for analysts, it's essential for a complete picture of financial health, impacting everything from enterprise value to solvency. But when we talk about valuation, our minds usually jump to assets, stocks, and companies. But today, we'll quickly unpack the core principles driving the debt valuation and its practical implication. So let's dive into the fascinating world of debt valuation and gain deeper understanding with CA Vaibhav sir, our speaker for the session. I now request CA Jitendra Sanglani sir to kindly enlighten us with his invaluable words.
Vedant, speaker is Gaurav sir.
I just wanted to correct Vedant. It's CA
Gaurav
Gaurav Sukhija.
Sukhija.
Yeah.
I just learned Vedant is from Kirtane Pandit only.
Sorry sir.
ट्रांसफर दे देंगे अभी देखो.
So to start this on a lighter note, but so regards to the chairman of the WRC, who was actually been allowing us to host this session, Gyan Yagna series. We have 19th session today, and thanks to Chairman Sir for supporting the initiatives of Vikasa and allowing us to host this. And the best part is that he's there rather before 7 p.m. He stays there till 8:30. Even if I have to be somewhere, I was occupied the other day. I had to disconnect, but then I noticed that he was there till the very end, and he had given the closing remarks. So thanks, sir, for making our task easier as well as being there for the entire session. The speaker of today's session, which is on valuation of debt, very critical kind of component when it comes to valuation. CA Gaurav Sukhija, all the way from Delhi. He's not traveling, he's there from Delhi, but we are approaching him, and he has given his time. So thank you so much, Gauravji, for accepting our invitation, not just on this topic of valuation of debt, but sir, he mentioned that he was interested in taking the other topic as well, because I was finding a little difficult to have a speaker on topic which was on intangibles, and he actually accepted that as well. So thank you so much, Gauravji, for being speaker today and tomorrow as well. The team Vikasa comprising of say entire 17 members. We have Madhur here. Kritika would be joining in some time. We have Vedant who is doing the MOC today, and Mr. Prem Kumar. I fondly call him PK. So he is also there. And all my dear students, I welcome you all to this 19th session of Yagna series. Thank you so much for joining. I think this is a little technical because the kind of say participation we had in the earlier session, Gauravji, I wish to tell you that we had the highest participation of 120 plus kind of students. Today we are witnessing a little less, but at the same time, I think it's a niche topic wherein niche knowledge is being shared. So people who are really interested are joining. And as rightly stated by Chairman Sir in the very beginning, prior to the session, that it has a library value as well. So we are posting it on YouTube, and people across places are now, say, getting in touch with the sessions that we are posting there. So valuation of debt and security is very critical and crucial. I know I'm not the expert in this topic for sure, but I deal into it and I understand that there are a lot many aspects, be it credit risk, be it interest rate part, be it the policies of the government, as well as there is a duration part and all this. And apart from that, the ratings of the company, which is something that matters the most. So I think for companies as well as the people who are investing, the debt should be valued in a very, say, apt manner. And today, this niche topic would be covered by you, Gauravji. So thank you once again. And I look forward to have a meaningful, say, interaction with you during the session, because I'll be attending the today's session in the entirety. And I'm looking forward to gain a lot of knowledge from this session. We have tomorrow one more session, as I already stated. Friends, we are also having the industrial tour, that is educational tour, happening on 11th and 12th of this month. We are going to Ahmedabad from WRC, that is Mumbai to Ahmedabad, and we'll be visiting IIM's Ahmedabad, Gift City, as well as we'll be having a round of iHub. And beyond that, the next day on 12th, we'll be having a full day tour of SOU, that is Statue of Unity. So I look forward to students joining in for that as well. And with all this, I once again thank Gauravji, and over to you, Vedant, for the further proceedings. Thank you. Yeah,
Thank you, sir,
Vedant.
for your kind words. I now request CA Ketan Sayya, sir, to kindly set the tone.
Thank you, Vedant, learned speaker for this session, Gaurav ji, Chairman Vikasa Jitendra ji, PK, I can also may call him as a PK, Madhur, who is also online. Thanks to entire Vikasa team for a wonderful Gyan Ganga. Also, Jitendra ji mentioned about my attending. Of course, it was a selfish interest to learn also. I am also getting out of touch if I don't listen to such session. So the session that day was very, very interesting, and I thought let me be also get updated with what is happening across in the valuation arena. Today again is such one topic, debt. I don't know if it is a simple debt product. It is, let's say 100 rupee debenture. I will think that what is the valuation? It will be 100 rupees. But of course, the dynamics have changed in the entire debt market. And today we have, so many dynamic products. Something convertible, something, having some other terms, conditions, and then rightly told by Jitendra sir, and it depends upon, those NPA criteria also, where people are not paying, defaulting, credit worthiness. And that's how that debt simple of 100 rupees can increase, decrease, or whatever, depending upon, those convertible nature and various other coupon rates and all those various aspects. So that's how the topic is interesting. And, we have one experienced personality who's agreed to share the knowledge with all the future chartered accountants. So Gauravji, thank you so much on behalf of Western India Regional Council for your valuable time. And it's a sheer coincidence that there's an article from Ketane Pandit in our team, and he's volunteering today. Of course, none of us knew also that part. So that's how Vedant is here. And Vedant, thank you to you also for sparing your time. With this, once again, congratulations to entire Vikasa team for wonderful Gyan Ganga series. Looking forward for an interesting session from Gauravji. Thank you.
Thank you, sir, Ketan Sayya, sir. I would now request Prem Kumar to introduce our dynamics speaker for the session.
Over the past sessions, we have explored many facts about finance, accounting, and valuation. Today, we will dive into an interesting session: valuation of debt, understanding the value on the liability side. And to guide us through this insightful, interesting session, we have with us a dynamic and deeply knowledgeable professional, CA Gaurav Sukhija. CA Gaurav Sukhija is a partner with valuations and transactions advisory practice at Ketane Pandit and is based out of New Delhi. Gaurav sir, is also a registered valuer under IBBI. Gaurav has worked under experience spread across providing valuation advisory, due diligence, etc. As a valuation professional, Gaurav has undertaken valuation of business, tangible assets, intangible assets, and customer relationships, financial instruments, and loan assets to assist the customers and their clients for fundraising as well as corporate restructuring. Gaurav has worked with Deloitte under the Financial Advisory Services Division and with SS Kotari Mehta and Co. in Mergers and Acquisition Division. Gaurav has performed several roles ranging from audits, compliance advisory during the course of his career, which gives him a view and understanding of overall operations of the company. Gaurav has done valuation of industries such as IT, ITEs, startups, fund house and manufacturing entities, automobile company, trading entities, and blockchain-based companies. So get ready to strengthen strengthen to understand the valuation of debts. So please welcome CA Gaurav Sukhija as he takes us through the extremely valuable session. Over to you, sir.
Thank you very much to all the members present here. Special thanks to our dynamic chairman of WIRC, Mr. CA Ketan Sayaji, our chairman of Vikasa, CA Jitendra Sanglani ji, our volunteers here, Vedant, Madhur, and as everyone calls him, PK, Prem Kumar. So, it's a wonderful initiative taken by Vikasa. I would, ideally applaud Jitendra ji's thought process and Ketan ji's support in creating this, and to all the volunteers who are here. Valuation is a very niche topic in itself to a greater extent. Having a audience of 120 for looking at and watching into valuation shows the kind of interest the capital markets and the valuation has in the western side of the country. When I come from the northern side, though I'm national leader transaction advisory. So I look at various aspects across the country, but I always see that the students in the valuation in the western side of the country are always more interested to understand the valuation aspect, the transaction advisory aspect in those areas. And it's beautiful to see that. Valuation itself is a beautiful area. I've been in this line for like more than 15 years now. I do not less than 200 valuations per year. My team and I, alongside my director and managers, does this. But debt is one side of the valuation, which you would ideally always think, is uh, anyone going to actually look at debt as a valuation as well? People come for valuation of assets. Who comes for valuation of liability? Understanding valuation on the liability side, even thinking of this topic, and also ideally having a presentation for 1 hour, is a beautiful aspect to have again. And I looked at various aspects of valuations which I have done. While I was doing this presentation, I was making this presentation for the first time, to be honest. And in the past, I've done overview of valuation. How do you do valuation? How do you do DCF? Intangible was one presentation which was already ready with me. So by the time I was approached to take up the liability side, I volunteered to take the intangible asset side, because I said at least that presentation is ready. I can create this one. So my team did a wonderful job on making this presentation. But for the purpose of doing that, we had to actually look at the whole framework of the debt instrument, of the bond instrument, and those areas. So let's understand why, and ideally what are the type of debt instruments we have. So the first and foremost kind of debt instruments which we have are, always considered as the government bonds. People consider government bonds as the first set of the debt instruments which are available. Now, debt is debt for someone and investment for others. So a lot of times you will see people getting valuation of the instrument, not of the liability they own. So if they are issuing an instrument, even equity is kind of a debt. You don't have to pay it. But over a period of time, your company may buy back the shares. The company may give returns over the equity and all of those areas. But debenture or bonds are such which are getting issued by someone. Now, anything you issue in India, we need to get the valuation done. So the first and foremost are the bonds, which are the government bonds, municipal bonds, corporate bonds. Now, government bond and municipal bonds are generally not valued. Corporate bonds are generally valued for the purpose of the income tax. So we'll come to that for the purpose of FEMA, for the purpose of SEBI. We'll discuss about the whole process. So in this full presentation, we'll talk about the type of debt instruments, on which instances valuation is ideally needed, under which statute, and you'll be amazed to see the kind of statutes under which you need to get the valuations done for bond. You would ideally say, if someone is practicing only in the debt valuation and leave behind all other valuations, this is the line. You will not have time to move your head away from the laptops, and you will only be doing debt valuations. That kind of compliances and regulatory requirements are there while you do a bond valuation or a debt valuation. So, and then we'll talk about basic aspects which we need to look at while we do a debt instrument valuation, and what methods we choose for doing the debt instrument valuation. With this, the holistic approach of doing the debt instrument would ideally be covered. So the first and foremost is what kind of debt instruments are there. These are government bonds, municipal bonds, and corporate bonds. Yeah. Then comes debentures. So we have convertible debentures, which can be converted into equity share. Non-convertible debentures, which cannot be converted, which are pure debt. Now, then there are partially convertible debenture, which are part debt and part converted into equity. Now, what happens is, while we look at Ind AS, under Ind AS, you need to bifurcate an instrument into debt and equity. So let's say there is one instrument which is partially convertible, which is optionally convertible redeemable debenture, OCRD. Let's say that. And or let's say it's a for the ease of doing it, let's say it is a compulsory convertible debenture with a coupon rate of 8%. So the 8% coupon rate, when valued over a period of time and time value of money is considered for that, that valuation is ideally the debt portion of that instrument. The rest is the equity portion because it is compulsory convertible. If it is optionally convertible, there are various methods to do the valuation. In those cases, there is binomial, there is Black-Scholes, there is n number of ways by which you can do a bond valuation or debenture valuation. Then comes preference shares. Now, generally, preference shares are very similar to equity shares, but in few cases, even preference shares are considered as debt instruments. Now, why you consider a preference share as debt instrument? I'll tell you. When we do a valuation, to calculate value per equity, we need fully diluted shareholding pattern. Now, what is fully diluted shareholding pattern? Which means all the debentures convertible, all the preference shares which are convertible are considered converted. And then a total shareholding pattern comes, and then that is divided. Ideally the equity value is divided by the number of shares, and you get value per share there. Now, the point is, when it is a compulsory convertible preference share, but it says it will be converted at a fair market value, and there is no fixed value to it, then you have a catch. That is, preference share is ideally a debt. Because what you are doing is you're locking the ultimate value of the preference share. You are saying you paid me 100 today. My value was 100 rupees per share. I am going to give you whatever, let's say 3 years down the line, I'm going to give you at a valuation of 300. So the value of the total instrument is locked. Then in that case, it is working like a debt only. And if the conversion is at a fair market value, which means that he could have entered at that moment of time only. He could have entered after 3 years. So then they demand a coupon rate. They would ideally say that in case I need to get the shares at a fair market value, I would want to have the coupon associated with it as well. Now, they will have an upside on the equity when a price is fixed at the time of conversion. So a nice thing which is there in the Indian law is that the valuation has to be done for the purpose of convertible as per the share capital and debenture rules, either at the time of issuance or at the time of conversion. So either at the time of issuance, you choose at what price will they be converted at, or at the time of conversion, you have to get the valuation done and converted at the fair market value. So debentures, bonds, preference shares are generally the most common one. Then comes commercial papers. Commercial papers are generally unsecured promissory notes by the corporate, which are very less used at a lot of times. Certificate of deposits, again, short-term deposit by banks and FIs. Zero coupon bonds. Now, these are very common in case of holding company giving shares to a subsidiary company, or holding company giving money to a subsidiary company. They issue it at the basis of zero coupon bond. So issued at discount, no periodic interest, redeemable at face value. Now comes perpetual bond, no maturity, pay interest indefinitely. Now these bonds generally have a long-term value. If you are getting interest over a period of time and you're not getting the principal, these have to be valued on the basis of capitalization. Then comes structured debt instrument, which are mezzanine debts. Mezzanine debts are ideally hybrid debt equity instrument. What are hybrid debt equity instrument? Optionally convertible, redeemable preference shares. Or there may be a debt instrument which may also have a convertible equity clause in case the person is not able to make the payment. Now, with these kind of debt instrument, or sometimes there is, I'll give you a very nice example of a debt which I came across just few days back. What happened was the debt was structured in a way that, number one, they needed an IRR of 18% return over the instrument. That was one. Second was, if the company has a liquidation event is what? Let's say IPO, secondary sale, or something like that. Not the negative liquidation event, or maybe a negative liquidation event also, but this was positive liquidation event. If that happens, then it was very clearly written, from 18% to 24% of returns will be retained. So in case, they invested 100 rupees and they're getting 124, 124 will be retained by the investor. So that was the max he can get, 24. The second was from 24 to 30, the second bracket. In that, they were sharing 50-50. So they were saying if the returns goes more than 24%, it goes till 30. So other, you will get 3%, I'll get 3%, 30%. Then there was another slab, more than 30%. 75, 25. 75 goes to the company, 25 comes to them. So only that kind of return will come to them. Now, last but not the least, 35%, which they said is ideally not achievable because it was already at a higher valuation. They said if that happens, then 100% goes to the company, you are done with it. Now, these things, when you value, it's not that easy. You need to look at the mezzanine side of it. How are you looking at those things? Now comes subordinated debt. Now, what is a subordinated debt? Lower priority on liquidation hierarchy. So there may be three types of debt. One will have first liquidation preference, second will have second liquidation preference, third will have third liquidation preference. So these are called subordinate debt. Generally, when anyone VC, PE firm, or a bigger organization is actually investing into another company, they say it will not go for a subordinate debt. We want to go with the senior PTC, which is securitization debt instruments, or PTC, ideally pass-through certificates or something like that, which they generally say we need that, we don't need anything else. Now comes this securitization debt instruments or securitization transaction receipts. These are ideally issued by a lot of trusts for the purpose of giving money to the AIFs. So those kind of investments which are going into AIFs, alternate investment funds, which are going into asset reconstruction companies are going through the PTCs, which are securitization debt instruments. Then comes foreign currency convertible bonds, FCCBs. These are issued abroad, convertible into equity. That is foreign currency. These are issued abroad to someone who's a non-resident. It's issued in USD and they're convertible into equity. Then comes simple loan instruments, very simple: term loan, syndicate loan, project loans, loan for specific project, syndicated loans, loan provided jointly by multiple lenders, and term loans. Then comes distressed debt. So distressed debt is issued by distressed companies, trade at discount. So generally, it's for the purpose of uh, higher interest rate, but lower value of returns, a lower value of the principal coming back. So those are generally valued at traded at a discount. Yeah. So going forward, yeah. So coming to why valuation is needed. So can anyone tell me, if we have the chatbot open, can anyone tell me why the valuation is ideally needed? Everyone? Can anyone tell me why valuation of a debt instrument will be needed? A liability instrument will be needed. Can anyone tell me? To know the current market value? Definitely, but I understand valuation is for the current market value. For price discovery, Sainath, wonderful. For price discovery, yes. Anyone else, please? Shiv Jyoti said to know the current market value, which is wonderful to understand. How much debt is companies holding, whether too much debt or not? Generally, it is available. How much debt the company is holding is generally available by the book value of the debt as well. But yes, absolutely. To know the net assets, yeah, Jay, perfect. To know and the net assets at the end of the year. For investment decisions as well as risk management. Wonderful, Tisha. You're saying that at the time of entry, you need a valuation. Now comes Meet saying to comply with law and regulations. Obviously, Meet, all the valuations in the case of debt are generally initiated by the government, and then we follow those rules and regulations given to us by the government itself to definitely to comply with laws and regulations. Anyone else? Anyone else? This is Vikasa. We need to have that energy of the students. If we don't have that energy of the students, what's the difference between the member and the students? Is that you are more responsive. You have more, urge to learn. If that's not there, so I'll keep asking questions and I'll keep expecting answers from all of you. Yeah. Yeah. So now coming to the valuation, why valuation is needed. First and foremost is the financial reporting and accounting. So, as everyone was talking about, that why valuation is ideally needed. It is needed for, let's say, in case of initial recognition under Ind AS 109 and IFRS 9, the valuation is needed under the initial recognition. That is at the time the company is issuing the debt instrument, the company needs to get the valuation done. This is needed under two statutes. One is Section 56, subsection 2, clause 10 of the Income Tax Act, which says any person receiving any property, any person receiving any property other than immovable property for a consideration which is lower than the fair market value, then the fair market value minus consideration shall be income under other sources in the hands of receiver of the instrument. बड़ा मुश्किल हो गया. अगर 56 to 10 पढ़ा होता, if you would have read that, you would know about it. But if you have not read that, I'll make it simple for you. If I do a debt instrument valuation and I say the debt instrument is valued at 1 lakh rupees and you are issuing that debt instrument at 90,000 rupees, 10,000 rupees worth of the money will ideally be taxable under other sources in the hands of the receiver of that. So the receiver is who? Not the receiver of the money. The receiver of the instrument shall be taxable in that case. Next is year-end mark-to-market valuation for audited accounts. Ideally under Ind AS, the valuation is needed at the end of the year. Impairment testing, obviously for expected credit loss. A lot of times you would have given debt to a company which is not able to service the debt of other companies. So what you need to do in that case is you would have to impair that asset in your books, the asset, loans and advances. So generally, debt is not valued at the end of the year. What is valued is the asset which is held in the hands of the investor. So that's a debt instrument which is getting valued, not the liability is getting valued. The liability in the books will remain at the same value because liability was created on day one. Asset was also created on day one. When on the day one the asset was getting created, initial recognition and subsequent measurement was needed under Ind AS 109 and IFRS 9. Now, when you're doing the valuation, year-end mark-to-market is needed. Second is impairment testing. Third, in case of purchase price allocation. Now, can anyone tell me what is purchase price allocation, please? I look forward to the answers from everyone. What is purchase price allocation? Tomorrow, you are gonna, for startup funding, or kitna debt company can raise. Good, Arpit. You have a good English answer to it. Can anyone tell me what is purchase price allocation? Why is it done? Why is purchase price allocation done? Anyone? Jay Srivastav is saying consideration. To ideally divide the consideration into the purchase, into what you have purchased. So ideally, let's say you have purchased a company which had a net worth. So breakup, Meet is saying breakup of consideration based upon valuation of assets. Wonderful. So it's Shiv Jyoti is saying proportionate value allocation to the asset to get the value of the consideration received for the asset. Wonderful. Wonderful. Now, let's say under the purchase price allocation, the company has also received a liability. All the assets and liabilities need to be fair valued. There may be a debt instrument which is there in the company, or there may be a liability which may be there in the company which needs to be re-evaluated. So those re-evaluations would have to be done under the purchase price allocation. Yeah. So purchase price allocation comes, then come hedge accounting effective assessment, that is to check whether the hedge which you have taken. So a lot of time people are taking ECBs, external commercial borrowings. Now, if there is an external commercial borrowing, in that case, what happens is they take a hedge on the instrument. Now, does anyone remember the issue of IndusInd which recently happened? Yeah, it was around M2M, mark to market and hedge accounting. So the problem was around these two. So you can see the kind of impact the debt valuation can ideally have over a company's financials. So it's not that small to understand. It's not that big because that was a BFSI company, therefore the valuation was ideally higher. If that would not have been a BFSI company, might have gone a little lower as an impact. Now, coming next is regulatory and taxation compliances. So obviously, when you are doing anything and you are doing between associated entities, you need under transfer pricing compliance for related party debt transactions. You need FEMA compliances for inbound and outbound debt instruments. So anything you get valuation, you need to get valuation done under FEMA for any FDI coming into the country, or if you are investing into a debt instrument abroad, you need to get an approval also from FEMA. Now, RBI prudential norms for stress testing and provisioning. So there are RBI prudential norms which actually talks about stress testing and provisioning you need there. Then for SEBI, ADI, PFRDA compliance for NAV calculation. SEBI requires NAV calculation every year. ADI, which is regulatory department, they need NAV valuation. Similarly for PFRDA. Now, next is the case of business combination. Now, business combination was ideally covered here also, which was purchase price allocation and business combination. This is post the merger has happened. This is at the time of pre-merger. That is the time of merger, demerger, and slump sales. You need valuation of the liabilities which are there in your company. Now, next is the conversion of debt to equity. Now, there may be a lot of cases. So, can anyone give me an example of recent company whose debt has been converted into, equity by the government? Determining cost of funding, wonderful. VI, Vodafone, wonderful, wonderful. Yeah. So how do you convert that debt into equity? You need to get the valuation of the debt. You need to know how much they owe, what is the value which they may be paying over a period of time, and then that equity may be converted into. So conversion of debt to equity, share went down when the government said, we're not going to take more equity from you. Share went up when they said, okay, we'll take some equity from you. Like that. So those are the cases where you need the valuation. Yeah. So you will see a lot of live examples, which are there, which you may not have thought of, that are actually relating to the debt instrument. Equity valuation is a separate thing. BI is a listed company. Its equity is listed. There are a lot of debt listed companies as well. A lot, like for example, we're not allowed to talk about the clients' names directly at any portal. We're auditors to a lot of companies which have only debt listed, but non clients also, like Make My Trip got their instrument listed abroad, but they did not have their equity listed for a very long period of time. So they got their debt listed in Singapore. Similarly, a lot of companies get their debt listed abroad because they don't want to raise equity. They want to raise debt, so they list their debt instead of listing their equity. So then comes ideally your IBC, IBC resolution, debt buybacks, pledge enforcement, collateral valuation. So in that case, when you want to enforce the pledge, in those cases, you will need all of these. Yeah. So going next, investment and transaction advisory. So if anyone is purchasing or sale of debt instrument in OTC or private market, you need to get the valuation done. It is for internal management analysis. Then for fundraising, convertible debt valuation for investors. So if anyone wants to raise funds, how will they get the raise fund? They need to first understand convertible debt valuation for the investor. Then comes distressed debt acquisition by ARCs, asset reconstruction companies, or by other companies in the similar sector. So ARCs or special situation funds. Internal NAV calculation for AIF. For the purpose of AIFs have invested into the debt instrument of a lot of companies. So you need to get the NAV calculation done under the SEBI requirement for the alternate investment funds. Similarly, PEVC funds are ideally the alternate investment funds only, one or the other form of an AIF. So you need to get an internal NAV calculation done. The third party investment, which is fair price validation if you are doing a third party valuation. Similarly, for dispute resolution and litigation, you also need valuation, which is like settlement of creditor claim under NCLT, family settlement involving debt security, valuation in shareholder or partners dispute. So in those cases, you need to understand how much debt is there in the company. So let's say someone is talking about valuation in shareholder or partner dispute. Now, that company has taken debt of, let's say, 21% per annum from an unsecured lender, and you are ideally doing a family settlement for them. This special debt has to be valued and see how much is the present value. Now, how do you present value? We'll talk about that under the yield. We will come to that as a presentation as well. While I talk about one thing, I think I should tell you about the other, but then my mind reminds me there's another presentation altogether on it. So, be with me, hold your horses. You'll learn a lot of things here. So settlement of creditor claims under NCLT, you will get settlement of creditors and claims under the NCLT for sure. Court directed fair value for debt recovery. So you will have a lot of cases wherein court has directed for fair value for debt recovery, that how much debt is actually applicable on them. So for that you may need. Then comes treasury and risk management. So MTM valuation for treasury risk management, collateral adequacy of pledged debt instrument, monitoring financial covenants in loan agreement, and then additional scenarios, ESOP trust, valuation of intercorporate deposits and group restructuring, debt with embedded derivative options, cross-border structure, ECB, FCB. There's so much to do. Yeah. But if we talk about regulatory requirements of the debt, can anyone tell me two regulations under which act, sections, anything which you know, maybe a broader name of the act, maybe a broader name of the framework would also help. Can anyone help me to tell me what is the regulatory requirement of valuation of debt of instruments? Can anyone please? In the chat. So Arpit is saying Airtel is also asking for conversion of debt into equity. But Airtel is still, second contender to Jio at this moment of time. So I think Jay is saying Companies Act, wonderful. Regulatory requirement of valuation of debt instrument, wonderful. Companies Act, it is needed under Companies Act. Anyone else, please? Anyone else? SEBI Act, wonderful. SEBI is needed when you are issuing debt by a listed company or you are actually listing your debt only abroad or maybe in India. So that's another thing. Anyone else, please? Yeah. It's so simple. I have given so many examples in my last slide itself. IBC, Manan Kothari is saying IBC. Wonderful. Anyone else? Guys, be fast. The way you said Vodafone Idea, Vodafone Idea, Vodafone Idea. Similar way. Supriya is saying FEMA. Wonderful. Yeah. Income tax, Ind AS, wonderful. You've covered it all. You've covered it all. You've ideally covered income tax, Ind AS, FEMA, IBC, SEBI, all of those. We need valuation under all. But the beauty of the thing is that you needed Ind AS, income tax, FEMA, Companies Act, SEBI, IBBI, but you need under so many Ind ASs. You need under Ind AS 109 financial instrument for initial recognition. At the time of issuing the debt, you need the valuation. So initial recognition you need. Measurement at fair value, you need at the time of financial instrument and subsequent measurement at fair value. Every year you need to do that valuation. And then for impairment testing, you need to do the valuation. So what kind of debt or debt-like instruments are covered here? Debenture, bond, term loan, CCD, OCD, preference share, with debt feature, all of these are actually covered. So ideally, all financial instruments are covered here. Ind AS 113. So Ind AS 113 is the father of all Ind ASs for the purpose of fair value measurement. So it tells you what kind of level 1, level 2, level 3 inputs you need. So Ind AS 113 helps you in that. And framework for determining fair value for financial reporting defines highest and best use, which is ideally known as HABU, HABU, HABU. Market participant assumptions. So it's required for all financial instrument Ind AS 113. Then comes Ind AS 103, business combination for the purpose of purchase price allocation. We were just talking in the last one that fair value of acquired liability and instruments. So you need to get the valuation done for them. It is acquired debt, ICD, debentures, and all of those. Then comes Ind AS 32, which is financial instrument. Classification. So as I was telling you in the starting, classification as debt versus equity requires valuation of compound instruments. So if there is an instrument which is optionally convertible, redeemable preference share, optionally convertible, redeemable preference share, you have a compulsory convertible debenture, you have non-redeemable are ideally not allowed in India. So all of these, you need to bifurcate them between debt and equity, and you need to have a debt portion. You need to have an equity portion separate. For that, you need to value the debt portion, and whatever is left is ideally the equity portion of the debt instrument. Now, comes next is Ind AS 107. So there may be cases wherein it is 0.001% compulsory convertible debt. Now, in that case, you really don't have any debt portion in it. It is 100 per 0.001% compulsory convertible debenture. No, there is no equity, there is no debt portion to it. It's purely equity portion, but it's still called debenture. Yeah. So you may call it debenture for the purpose of doing less compliance, for the purpose of actually being faster, for the purpose of giving them better liquidation preference and those things to the investor. But that's again not a debt altogether. But you have to keep revaluing them for the sake of it. Now, under section 56 to 10, when you go to Rule 11 UA of the Income Tax Act, Rule 11 UA tells you that in case of any instrument which is other than. So can anyone tell me, if anyone is in the practice of valuation, this is ideally a difficult question, so I'm expecting less answers. What does Rule 11 US say for the purpose of valuation of instruments other than equity? Can anyone tell me? Rule 11 UA sub rule 2 clause 1 sub clause C. What does it say? मुश्किल हो गया थोड़ा. Anyone? इधर उधर हो गया होगा थोड़ा सा, sub clause something like that, but generally, Rule 11 UA, preference shares act as debt in case of preference dividend right. But it doesn't say like that, no. It says something very specific for the valuation. Now, generally for the purpose of equity, it says A plus B plus C plus D minus L into PV by PE. Now, it's actually abbreviation or longer calculation of a net asset value method. It says for equity. What does it say for any instrument other than equity? What does Rule 11 US says? Anyone? No? Okay. So it says the price it will fetch in the open market, which means fair market value. So beautifully, Income Tax Act has said the price it will fetch in the open market is the fair market value of the company, of that instrument. So you need to do that valuation. So comes require disclosure of fair value, yeah, of hierarchy for financial instrument, all debt instrument. This is disclosure. Ind AS 107 just talks about financial instrument disclosure. Ind AS 32 talks about debt versus equity. Ind AS 109 talks about initial recognition and subsequent measurement of fair value. Ind AS 113 tells us how to do the valuation. Ind AS 103 says at what time you need to do the valuation. This is WH of the valuation. So you need to ideally do valuation by is because of Ind AS 109, Ind AS 103, Ind AS 32, Ind AS, no, ideally it is why are these three. Now, how you do the valuation is Ind AS 113, yeah, and then what disclosures are needed is Ind AS 109. So, and who does the valuation is ideally the registered valuer who does the valuation, which we will come to next. So WH family is ideally covered here. So let's go next. Next is ideally Income Tax Act and FEMA. So we were talking about Rule 11 UA, Sub Rule 2, FMA determination for issuance of share to ensure no understatement for tax avoidance. Rule 11 UAA, which is required for the purpose of slump sale. You need a valuation there as well. Section 50 CA is FMV required for transfer of unquoted share. Also affect debt like convertible instruments. So it also covers debt like convertible instruments. So section 50 CA is the section charging section of the capital gains over the transfer of an unquoted share. So the convertible debentures are also covered there. Section 45 Rule 11 UB and 11 UC indirect transfer of Indian assets. Fair value needed if debt instruments are part of an underlying entity. So if there is, can anyone tell me again? It's kind of same answer. Anyone tell me indirect transfer of Indian asset example? Maybe equity, yeah. Can anyone tell me? It's a landmark case in the country. Landmark case. Indirect transfer of Indian assets. What is indirect transfer of Indian assets? There is a US company. I'm just giving an example. No reference to anyone. There is a US company. There is a Europe company. Yeah. Or let's say there are two US companies for the sake of saying. The US company owns shares in the Indian company. Somebody acquired shares of the US company directly, not of the Indian company. The US company, which actually held the shares of the Indian company. Now, ultimately, what happens is while they acquire the shares of the US company, they become the owner there, and then they become the owner of the Indian entity. Now, with this is known as indirect transfer of Indian assets. This was part of a very big legal suit, tax legal suit. Wonderful, Shiv Jyoti, wonderful. I don't know, is my chat box visible to everyone? Is my chat box visible to everyone? I don't know if Zoom shows it or not. Yeah, can I have yes or no? Voda, wonderful, wonderful, wonderful. A lot of people knows the answer. Shiv Jyoti knows the answer. Raghunandan knows the answer. Sainath Jamdadwar knows the answer. Wonderful, wonderful. So, we have so much learned students here. I'm so happy to see this. It's great that, indirect transfer of Indian assets happened in Vodafone, but there were no debt instruments there. If they are there, you need to get the valuation done. Comes FEMA. FEMA, foreign exchange management, non-debt instruments, borrowing and lending regulation, ECB guidelines, and ODI regulations. All of these needs valuation via various people. Now, fair valuation via CA or merchant banker, pricing of ECB instruments, arm's length, which is external commercial borrowing instruments, arm's length, all-in cost ceiling linked to fair market conditions. Valuation when overseas direct investment involves debt or hybrid instruments. So we need to do those valuation, loans, advances, CCD. Now you see, we've just covered 3 acts. There are more to come. Yeah, we've covered Income Tax Act, we've covered FEMA, and we've covered Ind AS. Yeah, now we're gonna cover Companies Act as well, and then few other acts. Yeah. So then comes Companies Act. You need valuation under section 62 1C. It was a big case on retrospective taxation between GOI and UK parent company. Wonderful, Sainath. Wonderful. Third party transfer, it's also for Bayer Monsanto. Wonderful, wonderful. I'm aware of that, Vedant. So wonderful. Yeah. Now comes section 62 1C, valuation of convertible debentures. So section 62 actually governs the issuance of the convertible debenture or debentures in those cases. Section 47 covers the issuance of the equity instrument. Section 62 covers the issuance of the debentures and all of those. So this is ideally covered there. Valuation report needed for creditors approval, that is debt restructuring form and part of scheme. Compromise arrangement amalgamation, section 230 232, which is again mergers and acquisition you need there. This is a section which tells who will do the valuation. Now, under Companies Act, valuation shall be done or ideally must be done by a registered valuer. Now, who is a registered valuer? Who is empaneled on the Insolvency Bankruptcy Board of India. So, like in my introduction, Vedant was ideally talking about, or maybe Prem Kumar was ideally talking about me being registered as IBBI valuer. So similarly, and then comes section 186, which is loans and investment to be disclosed. So it's a disclosure section which talks about valuation required for proper reporting in related party structures. If you know, recently there has been a SEBI note which says that anything which comes between two related parties in case of a listed company has to have an approval under some requirements, under some basic changes, ideally some limits. It says that needs to get a approval from the audit committee. So that's wonderful to have. Intercorporate loans, what are covered here: CCDs, OCDs, debenture term loans, and all of those. So that's wonderful to have. Let's go next. Next is the SEBI regulation. So as everyone was talking about, SEBI ICDR regulation, conversion pricing of convertible securities by listed companies, you need there for floor price at FMB. Then comes SEBI LODR, disclosure of debt instrument. Now LODR is always disclosures. So it is disclosure of debt instrument. SEBI mutual fund regulation. So daily NAV for debt schemes. Whenever there is a debt scheme, you need to get the daily NAV done. SEBI AIF regulation, we were talking about that in the instances of doing the valuation where I was talking about AIF and VCs and PEs need to get the valuation done on the instruments where they have invested into as debt, or maybe they have issued, PE and VCs have issued those kind of instruments. Periodic fair valuation of portfolio investment, including unlisted debt, if they have any. Then comes IBBI and IBC, which is regulation 27 and 35 of the CIRP regulation liquidation, that you need to get the valuation done. In case of a liquidation of the company, resolution professional must appoint valuer to determine fair value, liquidation value, includes financial instruments. So you need to get the valuation done on the financial instruments there. These are all why. Why do you need a valuation? Why do you need a valuation? Now, how do you do the valuation? Yeah. So this is covered by IVS 101. International Valuation Standards, by the ICA Valuation Standards, which is 101 and 103. 103 actually governs how you do the valuation, and 101 is ideally the first standard which actually talks about the overall valuation aspects altogether. So ICA valuation standard is where you get the reference from for doing the valuation. Then comes IBBI, IBC, SEBI regulations. So these are the regulations under which you need. So it is Ind AS, IFRS, Income Tax Act, FEMA, Companies Act, SEBI, IBBI, IBC. Now you see, this is just a stone in the ocean kind of a valuation. It is so small segment in the side of the valuation, but it's still so huge. The regulations around it are so huge. The kind of valuation you're doing are too much. The kind of methods you have to do of doing valuation are too much. So can anyone tell me, you've been part of this Gyan Yagna and you've done some sessions already. Can anyone tell me 3 approaches of valuation? Anyone, please? Fast. 3 approaches of valuation. This is my first question when I take an interview of anyone I am hiring. 3 approaches of valuation. Now, comparative is not an approach, Nikhil. Comparative is a method. So it's not an approach. Can anyone tell me approach? MTM, mark to market? No, I'm sorry, Sabrish, that's not the answer. DCF. Again, DCF is a method. Wonderful. Meet got an answer. Meet got an answer. Arpit, again, market cost. Yes, you can say that, obviously. Market cost and income. Wonderful. Arpit got the answer right. Meet got the answer right. So it's income, market, and asset approach. Market cost and income approach. Wonderful, Arpit. So that's great. So I've got the answer. So it's, methods of valuation are always the same. So whether it is cost approach, income approach, market approach. But what happens is, in case of debt, generally, oh, sorry. Yeah. In case of debt, very rarely you choose NAV valuation, which is the cost approach. Therefore, debt may apply for distressed receivable or recoverable value in insolvency. Sometimes, in case of stressed assets, you may use it for the purpose of insolvency. Comparable transaction method, which is use observable prices for identical or comparable instrument traded in active market. Or income approach, which is discounted cash flow method. Ideally, 90% of the cases you'll choose discounted cash flow method, which is ideally not discounted cash flow method. It is present value of future expected cash flow relating to the debt only, discounted at a market-based yield. Now, this is very important. Discounted at a market-based yield. We'll understand this in more detail. I'm just checking the time we have. So we have 15-20 minutes more. We need to cover this by 8:15. So 15 minutes we'll be able to cover. No problem. Yeah. So market-based yield, then use observable prices for identical or comparable instrument. You generally don't get comparable instruments traded in active market. So you can't really find 2 listed bonds being very near to each other, and then you may choose to do that. It's generally not there. Market approach is a kind of a level 1 input which you use, a level 2 input which you use in the income approach, which is ideally the level 3 input of the valuation. I am talking about from the perspective of Ind AS 113, which is talking about the fair value. Yeah. So let's go next. Yeah. Discounted cash flow valuation method, as everyone was talking about DCF, income approach. DCF is one of the method. Yeah. Approach is the income approach. Then comes key concept. Calculate present value of all contractual cash flows, discount using a market yield for similar. Comparable transaction method is again under market approach. Derive value using prices of comparable traded debt. Market quote method, which is market approach. If your debt is ideally listed on any OTC platform, you can take the value directly from there. Asset recovery method, which is rarely used, which is the cost approach used for stressed debt. In that case, so you can choose to take that. That's another thing to do. Yeah. So next is valuation methodologies, and let's compare it to the instruments which we may choose to. Now, in case of market code, you can do only listed corporate bonds. Only listed corporate bonds can be valued via this. Most of the valuations which come to you will come for privately placed debentures. So these are the general valuations which you will get. You need to get them valuation under DCF method. Convertible debenture, again, DCF for debt portion and option pricing model for equity portion. Then come intercorporate deposits, again DCF, distressed loan, asset recovery method. So you see, if I talk about four major assets, it's listed corporate bond, privately placed debenture, convertible debenture, intercorporate deposits. Out of these, three are getting valued via DCF. And just one because the market quote is available, so you choose to take that. And then asset recovery method is a distressed loan asset method. So therefore, in most of the cases, you will find that you are using the DCF method for doing the valuation. Yeah. Now let's talk about important aspects of debt valuation. Okay. Jisne pad liya, that's wonderful. Jisne nahi pada, that's another thing. Can anyone tell me few aspects of a debt instrument? Aspects of debt instrument. Can anyone tell me, please? Aspects of debt instrument. मुझे ऐसा लग रहा है मेरे को ना stop sharing करना पड़ेगा so that I am able to get this. Yeah. Market cost and income तो वही है. Can I have answers, please? Tenure of instrument. Wonderful, Sainath. Tenure of instrument is one. Convertible है या non-convertible है? Maybe Vedant. Wonderful. Interest rate, Manan Kothari. Wonderful. Coupon rate, interest rate are both synonyms, so that works. Sainath is saying liquidity of instrument. Next, others, please. Faster. Premium. Nikhil is saying premium. At what premium they will be converted at? So that's also very, very important. Wonderful. Security. Arpit is saying security. That is the collateral it has behind it for the purpose of this. So that's another good thing to have. Anyone else? Shiv Jyoti is saying redeemable or irredeemable. Definitely. It's convertible or non-convertible, which ideally was told by Vedant. So credit risk or rating, wonderful, Manan. Credit risk or rating is also very important aspect. So you know most of the things, yeah, or maybe you saw it while I was just giving a glimpse of it. So what are important aspects are coupon rate, that's one, yeah. Then comes maturity, tenure, which we were just discussing. Longer tenure, higher interest rate risk, discount rate must reflect term structure. Yield to maturity, IRR, equating price with all future cash flow. We will talk about this in just maybe next slide or something. Then comes credit rating and default risk, which is very important. We need to take. So anytime you're doing a valuation of the debt instrument, you need to ask the client about these things. Interest rate risk, call put conversion option. So as we were just discussing, whether it is convertible, non-convertible, who has the call of doing this? Now I'll tell you. Very beautifully put. One company, Ajay, tell me one thing, which is more costlier? Let me ask this question first. Which is more costlier, debt or equity? Can anyone please answer me this? Which is more costlier, debt or equity? Which is more costlier, debt or equity? Sainath, right answer. Karan, right answer. Right answer. Shiv Jyoti, wonderful. Tisha, wonderful. Akash, wonderful. Koi to galat answer karo. Yeah. So everyone is saying equity is most costlier. Now tell me one thing. Let's say you are an issuer of the instrument. You are the issuer of the instrument. Issuer कौन होता है जिसको पैसे मिलते हैं? Who actually issues the instrument. Now, you have the call option to either convert or redeem. You have the call option to either redeem or convert or redeem. What in the right mind you will always do if your company is doing good? Redeem it or convert it? Everyone, can I have the answer? You are the issuer of the debt instrument. Will you redeem it or will you convert it? What will you do? Shiv Jyoti is saying you will convert it. Jay Srivastav is saying you will convert it. Sainath is saying पहला कोई question ऐसा आया जिसमें there's a conflict. Yeah, convert it. Karan Bhandari is saying we'll convert it. Manan Kothari is saying we'll redeem it. And Akash Bhatti is saying we will redeem it. when, so I gave you the answer before asking the question, wherein everyone answered the same question, answered the same line. Which is more costlier, debt or equity? Equity is more costlier. Debt is less costlier. So if you have the option to redeem the debt, why will you give them equity? When you have something which is on the lower side of the cost, why will you, to secure my share percent, redeem? But I'm not that liquid, I will convert. I'm saying you're doing good. I said you're doing good. I said when I started talking about it, you're doing good. Yeah, you're doing good, you will always redeem. And whenever any valuation comes to you, they don't come into a stressed asset valuation to you. It's a very rare case you get a stressed asset valuation. But let us see what is smart pen. Okay. So if you are ideally having an option to either redeem or maybe convert, if the issuer has the option, he will always redeem if they are doing good, if they are profitable. If they are going to be profitable in another 5 years, they will always redeem. Yeah. If in case the uh, lender has the option, then he can choose. How does he choose? He chooses between the redemption approach and the conversion approach. And he sees where the value is actually increasing, in the redemption approach or in the conversion approach. So he will choose to do it as in he may want to. Now, whether it is secured or subordinated, definitely. Liquidity, then comes covenant and terms, and then come market conditions. So these are few of the cases to important aspects of debt valuation. Yeah. So let's go next is valuation methodologies for the purpose of calculation of yield. That is the cost. At what discount rate will you actually, cost of debt ideally, or the discount rate at which you will discount the earnings which you will get from the debt. The most chosen method, which is generally considered, is the FIMDA spread, which is FIMDA, FBIL, benchmarks. No, FIMDA, what it does, it gives you a yield altogether. It tells you this is the yield over and above the corporate, over and above the credit risk the company has. So let's say it is a AAA minus bond, it will have a 5% over and above the risk-free rate. So you may choose to do that. That's one. But this is generally available with the companies which are BFSI. FIMDA is generally a costlier thing to have. So people choose to do other areas, which is risk-free rate plus credit spread. So what do they do is they take RBI GSEC yield, and then they take CRISIL spread tables or ICRA rating spreads and all of those things, and then they do the valuation in that case. So those kind of things also happen. Now, next is comparable traded instruments. So how do you calculate YTMS? Let's say your instrument is 10 years. Your instrument is, at similar credit rated. You are AAA minus. There's another AAA minus company, which is whose debt is actually listed. You will see what kind of returns they are actually giving. So let's say they are trading at a 9.5% YTM. You use that as a discount rate. Yeah. Coming to internal cost of borrowing. So, it's generally internal cost of borrowing. Your company may be raising debt at some rate. So if you are raising debt at 10%, you will ideally consider the internal cost of borrowing to also be the YTM in that case. So you will value it accordingly. Similarly, market sounding or broker quotes, credit rating agency spread. These are few of the things which you consider while you do the valuation. Yeah. I will take you through one of the reports which we do just after this. Yeah. This is one of the report which we have recently done, valuation of of investment in ABCD. Now, this was a debt instrument. One of the company, it was a debt instrument for them. So we did that as a valuation. We looked at, how the company is getting valued and those areas. The important thing to look at here is that we looked at whether the company will have as per redeemable approach or will it value as per the conversion approach. Now, because this is going to the library as well, I can't really be, showing other slides to a greater extent. But you look at this, they value investment as per the redemption approach or the value as per the conversion approach. Now, as per the redemption approach, that was coming 4 crore rupees for the loan amount, which was August 21. So loan amount was 3 crore, April 22, 3 crore. Now, you look at as per the conversion approach, that was 4.2. In April 22, it was 4 crore. So higher of that because the lender had the option of conversion. So therefore, we chose to have 4 crore here and 4 crore here. We also used simulation here, which was ideally, Monte Carlo simulation for doing the stock price valuation. We came down to a stock price valuation of 2501. And then we went to those other areas to do. How do we calculate cost of debt? Cost of debt is again, so as I was telling you, we look at the India bond yield for 6 years and 7 year. We look at a FIMDA spread, which is 5.11% and 5.08. We consider triple B minus because the rating was not available. Now, because the rating was not available, we added a markup of 25% to it, and then we did an effective bond yield calculation. So this is how you do a live valuation as well. So this is something about us, how do we work, and all of those things. I am thankful to all the people who are present here, Mr. Ketan, Mr. Uh, you know, uh, Jitendra, Mr. Vedant, Mr. Madhur, Mr. Prem Kumar, and all of those. Thank you very much for this session. I believe I was given till 8:15, so I have tried to complete my session by 8:15 itself. If there are any queries, I am very happy to take them. And it's ideally late in the evening. You people can enjoy your Wednesday evening. Wonderful. Thank you very much for being a wonderful audience. Thank you. Thank you very much.
Thank you so much, sir. This is Kritika Jain, and on behalf of the entire Vikasa WIRC team, I am privileged to deliver the vote of thanks for today's session. And as we conclude this packed session, let's take a moment to acknowledge all the pillars who made it possible. We begin by expressing our deep gratitude to the leadership of WIRC, CA Ketan Sayya sir, the chairman of WIRC, whose progressive vision drives initiatives like these. CA Piyush Chandak sir, the vice chairman, to CA Chinal Savla ma'am, the secretary, to CA Pranal Shah sir, the treasurer. Your constant encouragement continues to inspire the student fraternity. And a heartfelt thank you to CA Jitendra Saglani sir, the chairman of Akasa WIRC, for his mentorship, enthusiasm, and belief that equipping students through knowledge-based platforms like Gyan Yagna. And a sincere thank you to the speaker of the day, CA Gaurav Sukhija sir, for sharing such practical, engaging, and in-depth insights into the world of valuation. And from decoding valuation methodologies to shedding light on the real-world application, your session was a perfect blend of technical expertise and industry wisdom. And to the entire Vikasa WRC team, thank you for your constant effort, coordination, and passion. And most importantly, to our participants, your curiosity, interaction, and thirst for learning is what keeps the spirit of Gyan Yagna alive. And here's to continued learning, meaningful interactions, and growing together as future professionals. Thank you so much.
Thank you. Thank you, Krutika. Thank you, Gaurav bhai. Wonderful session from you. And definitely we'll have sometime member section also on such topics.
Thank you, Gaurav ji. Thank you so much. Thank you, Chairman, sir.
Thank you.